welcome to today's More Report Chart Appraisals with me, Richard Perry, market analyst at Hantec Markets on Wednesday the 8th of November. We've got a relatively settled open on the markets today. Let me show you the markets board. That's not the markets board. That is. And we've got a slight air of dollar weakness, not too significant, as you've got euro sort of gaining ground a little bit, the yen also rallying against the dollar, pulling dollar yen lower, and you've got all these commodity currencies as well, a little touch stronger against the dollar. The only real factor is the sterling, which is underperforming. Political pressure continues to build on Theresa May, and what we're seeing is the dollar, which is sort of consolidating a bit. It's interesting that this chart actually shows dollar index slightly higher, considering the euro and the yen, which are the two major contributors to that index, are actually stronger against the dollar. I can't work that out personally. I don't know whether that's. It must be right, but I don't know why. Anyway, and you've got a slight air of a rebound on this 10-year Treasury. The 10-year Treasury came under pressure yesterday on the suggestion that the Republicans were going to sort of water down the tax reform by sort of delaying the corporate tax cut by 12 months, and that hit the dollar yesterday. But we do still see the 2-year yield rising higher. Now let me show you a chart that is really interesting. The 2 to 10 spread is now the tightest since 2007. We know that was already last week, but it's now 67 pips, or 67 basis points. That's 10 basis points below where it was back in 2016. So the yield curve continues to flatten in the States, and the implications of that flattening are yet to sort of really be known, really. I mean, theoretically, a flattening yield curve suggests potential for recession further down the line, but obviously the yield curve isn't flat yet. I mean, 67 basis points away from being flat from the 2s to the 10s, but yeah, this is still an eye-opener nonetheless. Despite this, we do still have this dollar strengthening on a net basis, certainly, although the last couple of days sort of a bit of consolidation really on that dollar index. But broadly speaking, this is happening, and what we've got to keep an eye on, I think, are two factors here. For euro dollar, I always keep an eye on the spread between the Bund and Treasury 10-year, and that has been rallying, or sort of, rallying, has been tightening that spread. And normally there is a positive correlation between these two lines here. And also the divergence between dollar yen and the 10-year Treasury. 10-year Treasury has been falling sharply, but the dollar yen hasn't. And that divergence doesn't tend to last particularly long. Lasted a bit, a couple of weeks in June, but then subsequently the two lines came back together. So that would suggest that either you're going to get the 10-year Treasury rallying again, coming higher, or the dollar yen falling. So keep an eye on that chart, I would. But at the moment we've got equity markets, which yesterday we saw the S&P 500 rebounding into the close and held up fairly well, but the DAX fell away sharply, and that has formed a near-term corrective signal. Equity markets have relatively settled though today. Now, in terms of data today, again, nothing really in terms of Tier 1. EIA inventories, again, drawdowns across the crude distillates and gasoline. We've also got the RBNZ tonight. No change expected from the RBNZ on monetary policy. Now, my chart today is the Aussie dollar. Now, what we have seen is the Aussie dollar forming this outside day. It wasn't a bearish engulfing pattern, but it certainly wasn't a positive candle in any way at all. And it certainly looks as though we're putting increasing pressure as the market is falling away. That rally last week hit that resistance at the underside of the old support, 77.30, pretty much to the pip, fell away. You've got a rebound high, 77 figure yesterday from early high, falling away, and it looks like the momentum indicators are sort of setting up for a downside break below 76.22, which was that low we saw a couple of weeks back. That low, that support hit yesterday, held on, rallied about 40 pips from there, but looks on the hourly chart as well as though you're still again just really unwinding back to levels at which the bears are coming back in. So I would say that this little rally on Aussie dollar today is going to be seen as a chance to sell. I think we're going to see further pressure on 76.20 and a breakdown below that. You're looking at sort of probably a move back towards this old pivot around 75 figure. But you'd sort of continue this corrective move. You've got 75.67 is your next support of that July low, but certainly I think a breakdown below 76.20 would be another sort of indication that the bears are in control increasingly on this chart. So I wish you good luck in your trading today, and I'll speak to you later. Thank you.